The views expressed in this podcast are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome back to the U.S. Money Reserve Studios. I'm your host, Remy Castillo. And today we're going to be talking about a topic that I think a lot of Americans are concerned about, the banking risk. So we've invited two guests on the show today. And the first guest I want to introduce you to is Brad Chastain. He was the former manager of retirement education at Vanguard for 18 years. And I couldn't think of a better guest to bring on the show today. Brad, welcome to the show.
Thank you for having me. Excited to be here.
Thank you for being here. The next guest I want to introduce you to is a gentleman named Coy Wells. He's one of our IRA directors, and he's joining us remote in Austin, Texas. And Coy has been with the company for 16 years now. And so he gets a chance to hear firsthand from the consumers what their concerns are. So Coy, welcome to the show. Thank you for joining us today.
Thank you, Remy.
So I want to jump right into this, gentlemen, because I think, there's a lot of people that are concerned about banking risk, but what are banking risk? And so Coy, let me throw this right to you. What are some of the banking risk right now?
Very good question. Right now, what we're hearing on the phone and talking to consumers, Remy, is right now a lot of Americans that are in rural communities and small suburbs have seen their small community banks going out of business. And we know that according to some of the most recent reports provided by the Office of the Comptroller of Currency, that in 2024, we saw around 726 banks shut down across the United States. It doesn't necessarily mean that the banks are all going out of business, but it does tell us and give us some indication, very similar to 2008, that some of the larger banks are taking on some of the smaller banks. And in times where interest rates are high, right now interest rates have been high for such a period of time that the banks may not be lending the type of money that they were lending going back 3, 4, 5 years ago, where interest rates were below 3% or sitting around 3%. So right now, we are seeing some of those banks consolidate. So consumers are concerned that now their money is being transferred from one bank to another bank, and they're really questioning why. And for the consumer, it reminds them of what happened in 2008. We had a major financial institution that ultimately went out of business, but at the same time, the American people were experiencing a bank consolidation during that period as well.
Well, we talk about consolidation, Coy, and so I'm going to throw this to Brad because I was doing some research before the show, and this is what shocked me. The top 50 banks control $17.5 trillion in assets. That's a staggering statistic.
Absolutely.
How does this happen?
Yeah, for decades, we have seen bank consolidation. A few decades ago, there were over 14,000 banks. Now there's just over 4,000 banks. And it's really kind of led to that too big to fail scenario that we heard so much about with the bank bailouts post 2008. And the way that it affects a lot of the consumers that Coy was just talking about in rural areas is that one of the things that we've learned from the FDIC is that when large banks go in and take over small banks in a small community, they actually do less lending into that community. They lend more in aggregate, but most of that lending ends up going back to where they already had their primary business. And so the consumers or the businesses, the farms that are in those areas do have a more difficult time getting lending from those institutions now because they don't have the small relationships. They're not as familiar with that particular customer, their business, and even that general area. So we see overall lending go down, and it has become a challenge.
So, Coy, I'm going to throw this back to you because, Brad just brought up a really good point here. He talked about 14,000 banks and down to less than, I think, 4,036 banks, I think you said. That's 2/3. It's a 72% reduction, right? What should I be concerned about? I mean, am I going to go to my bank and is it going to be closed?
Well, that actually happened to me about 15 years ago. It was my first year here with U.S. Money Reserve. I had a small community bank here, credit union here in Austin, Texas. I'd been with them for about a year and a half, or maybe 2 years. And, I went through on a regular basis to deposit my checks on a regular basis, had a personal relationship with several of the people in the bank, went to go deposit a check on a Friday afternoon, and the windows were visqueened over. They had black plastic on the windows. And there was a cardboard cutout just basically stating 3 other credit unions that had my information and that I needed to contact one of them to go have access to my money. But it was a scary moment, needless to say. And what happens is in the United States, we've seen this before. We had the savings and loans crisis between 87 through 93, where we had a bank go out of business, taken over by the Federal Reserve, and people didn't have access to their money. And as Brad stated, these are small community banks that affect the farmers and ranchers of the United States. And that's a big deal when you start seeing small town America get concerned, because ultimately also what happens is that if you see your bank go out of business or get picked up by another institution, they've had patterns throughout the course of time. Our customer base is between the age of 70 up to 85, sometimes 90 years of age, and they remember the savings and loans crisis. Their grandparents grew up through the Depression. They remembered what happened in 2008 when Lehman Brothers went out of business, which ultimately led to a major recession here in the United States, but also led to a major global economic downturn as well, which again led to a housing crisis, 2 years later. So people remember when they start seeing these banks go out of business, it's just a reminder to them that there are things taking place from an economic standpoint behind the scenes that they're really not aware of, but more importantly, they really don't understand what's happening. And as Brad stated, these banks are taking on additional money, but they're not lending additional money in the areas that the people need it the most. And right now, we know that interest rates for the last 4 years have been relatively high, and they've been high to combat inflation, which the American people are also feeling. So they remember, and when they remember, they get more cautious.
Well, you talked about bank closures, and I'm going to ask Brad here for a minute because I was doing some more research. And First Republic, Silicon Valley Bank, Signature Bank, to the tune of over $500 billion in assets. This happened recently. This is not something that happened a long time ago. So,
Yeah.
what gives?
It's always something slightly different. And that's the thing. It's regulators are constantly trying to catch up to how the banking system evolves. 2008 caught regulators way off guard. The way that banks were managing risk through various derivatives, they had no idea how systemic it actually was. And we saw that again in the more recent ones that you just mentioned, the Silicon Valley Bank and the like. Regulations that came out subsequent to 2008 put in place measures where they had to hold a certain type of assets, mostly government bonds, in order to make sure that they'd be able to make depositors whole. However, with rising interest rates, in that situation, those assets fell, much like the derivatives that they had, the subprime loans that they had back in 2008. So as their concentration of depositors started taking their money, they couldn't sell all of those treasury bonds for as much as they needed to in order to give those depositors back their money. And that's where they ended up folding as well. So we always see government come in, put regulations in place to fix a problem, but other problems keep popping up elsewhere within the system.
Interesting. Coy, I want to ask you a question because we're talking about banks and banks closing, but the FDIC, does it really have enough money to cover one of these large bank failures?
That's a really good question. If you go to the internet and you just type in into Google and type in how much does the FDIC have, it'll tell you that they have an estimated $128 billion. So if you think about the amount of money that these banks have, $128 billion is not enough money to cover a major financial institutions. We also know that after Silicon Valley went out of business in the congressional hearing in March, that Janet Yellen was very concerned about the coverage that the FDIC had as well. The current vice chairman, Martin Gruenberg, also stated the same concerns, is that they really don't have enough money to cover a banking crisis if this becomes systemic. The second question becomes do they have enough assets? So for instance, if a bank begins, and Brad can maybe help support this in just a second, is that if a bank goes out of business, the Fed can step in and they have these assets that the bank is owning. The bank is then, those assets relinquished to the Fed. The Fed sells those assets like Brad was describing with treasury bonds. But if there's not enough assets to cover a major institution, they could be in a position where they run out real quickly, but you would have to have a crisis that would be of epic proportion, and we don't want to be in a position where we're scaring the consumer that there's not enough money in the FDIC. But what we do know is that the derivative sector that Brad talked about is one of the catalysts that caused the recession of 2008 with Lehman Brothers. We also know that as of recently, after Silicon Valley, going in August, we had a ton of banks that were downgraded by Moody's. There was 30 or 40 banks that were downgraded, and they weren't small banks. These were large banks. And then coming into November of 2023, We saw Moody's downgrade the credit rating of the United States, which is a very big deal because we've only seen that happen a handful of times in U.S. history. And one of the reasons for the downgrade was because of the banks. I think Moody's stated the inability of the United States to support the current banking crisis. We can't continue to keep bailing banks out and bailing banks out and bailing banks out without holding them accountable. The side of that is that it could be extremely painful to the U.S. economy and the American people at the same time.
So then what can consumers and customers do, Brad? What choices do they have?
I think one of the biggest things regarding banks is using them what they're really intended for. I mean, bank is a quick, easy place to get access to money, to pay mortgages, to pay rent, to pay bills, to hold even perhaps emergency funds to put a new air conditioning unit on the house or replace a vehicle or fix a vehicle, those types of things, right? The savings account, checking account, even CDs are not designed to be long-term held assets to build wealth. And so money that you know you're going to spend 6 or 8 months, it's ideally a small portion of your overall net worth.
Sure.
Having access to a bank to be able to do those transactions makes a lot of sense. But the issue comes, especially when people hold more than FDIC insurance, it covers and they hold too much. They're not only putting more of their assets at risk system, they're also just undermining their own financial well-being long-term because there's better things to do with money that you need returns for to keep pace with inflation, be able to maintain the lifestyle that somebody wants to going into retirement.
Well, you brought up something that I wanted to talk about. And Coy, I'll throw this back to you because I think this is something that I think, you said it best, right? Banks are intended to get access to money. But if you're putting in more than what the FDIC limits are, what are you really exposing yourself to in terms of risk? And what are some of the alternative choices that people have?
Very good question. We know that recently we had 2 major banks go out of business in Oklahoma, which they left consumers with about $70 million in uninsured deposits, right? So the FDIC got put in a pretty precarious position, but so did the consumers. Brad was exactly correct. Banks are intended to be able to have it there as a safe haven in times that you need, but it's not designed to actually create wealth creation over the course of time. We know that in 2000, ultimately that was caused because of a banking crisis. It was a dot-com bubble, but ultimately the banks got in trouble due to lending. During that period of time, we know the U.S. dollar lost around 27%, but we also know that gold showed an increase of around 300% over a 6-year span. That's an average return annually of about 48%. Now, each year wasn't consecutive in 48% return, but the average return over 6 years was significant when money was at risk. The same thing happened in 2008. U.S. dollar lost around 33%, where gold increased around 242% over about 4.5 a 5-year span. So moving that money into gold provides you protection in regards to getting it out of the U.S. dollar and getting it out of harm's way.
Well, how easy is it to get into gold? And Brad, I'll ask you this question because, people are looking for alternative places to put money. And gold is obviously one of the best places, but how easy is it?
It's really easy. And that's what we do here every day at U.S. Money Reserve is we walk customers that have never had any experience with gold whatsoever, that don't know the first thing about gold through the entire process. And it depends on what somebody's goals and objectives are. Is this money that they are putting away for retirement and it's in a retirement vehicle? If that's the case, then we work with them and we work with their current retirement custodian to move the money over into gold, and we do all the work for them. If it's something that they want to have at home, be able to look at it, touch it, put it in their safe, then we do that as well. We ship it right to the door, fully insured, and we make sure they understand what it is that they're getting and that they're getting the best options for what they're trying to accomplish.
So, Coy, I'm going to go back to you for just a minute. Thank you, Brad. You worked with both sides of the company. I think you worked in the physical asset allocation division. Now you're in the retirement division. Do the consumers that you talk to today, the customers that you're speaking to today, do they want both in their portfolio? Do they want to have gold inside of an IRA? Do they want to have gold at home? What are you hearing right now?
Very good question. Working on both sides of the division, when the consumer calls in, we kind of ask them a series of questions to really identify what their need is. In a lot of cases, the consumer is really unaware that they can transfer money from a retirement account that was a tax deferred account when they were working with an employer into a self-directed gold IRA. So first off, that's kind of one of the disconnects is them really not knowing that that tool is accessible to them. But if you look at the physical side of gold, those that moved money into gold from November, January until now have seen an increase of better than 30% on a 12-month span. So knowing that you can take money from a checking and savings account, make a phone call, talk to a representative here at U.S. Money Reserve through a very simple process and take that gold and have it shipped to your home is a very simple process. But the flip side of that is consumers also have access to be able to transfer a retirement account that's a tax-deferred account into a secondary tax-deferred account that provides them another layer of protection. But either way, Brad said it best. It's a simple phone call, and U.S. Money Reserve on both sides makes it very simple. And for the most part, we do all the work for you.
So, why wouldn't I just go to my bank, Brad? Why wouldn't I just go to my bank and open up an IRA there?
Well, if you want access to owning physical gold, you can't do that within a normal bank.
I guess that's a better
So-
question. Why can't you do that with a normal bank?
They don't have they don't have the processes in place. It's just not something that they offer. They don't even benefit from selling you gold. Is probably one of the big reasons why they don't do it. Banks are in the business of taking money from someone who is saving money, lending it out at a higher interest rate to somebody else who needs money, and they don't do that. They can't do that with gold. So when you go to a bank and open up an IRA, typically they put you in a CD, a certificate of deposit.
Mm-hmm.
And so they'll say our IRAs are paying this amount. An IRA doesn't actually pay anything. It's the CD inside that is paying a certain rate, right? So when a CD matures in 1 year, then what do you go do with it?
Right.
You have to do something else with it. You can buy another CD, but if rates aren't as high as they were, which they're coming down as the Federal Reserve right now has just a couple months ago started their rate cutting cycle. A year from now, it's very likely that rates are going to be lower. So somebody's not going to get that same rate as they go put that money back in there. So CDs are appropriate vehicles for somebody who knows exactly when they're going to spend money for a particular purpose, 1 year from now, and they just want to set it there. But if it's a longer term objective, then you come into that reinvestment risk of what are you going to do with it after it matures? They may not be paying the same amount. And so for longer term objectives, we usually look at different assets to provide the growth that we really need.
So, thank you, Brad. And Coy, I want to go back to you for just a second. When you talk to customers and you get on the phone with them and they tell you some of their concerns and you guys come up with a strategy and they say, well, my financial advisor told me he can sell me gold, right? Or somebody at the bank that they sit down with, an advisor says, they said they can sell me gold. I can buy gold. What are they referring to?
What they're referring to is paper gold ETFs, right? But there is a substantial difference between a paper ETF versus physical gold. You're still sitting in a paper asset is being leveraged. Just like when you buy a stock, those stocks are being borrowed against and leveraged against, as Brad indicated earlier, as banks need cash in the bank to be able to lend against.
So it's not a tangible asset. Is that what I'm getting? It's not a tangible asset. If I go to the bank and I sit down with the advisor and they sell me a gold ETF, it's a paper, it's like a stock. It's not the real metal. And if I buy it in an IRA with a gold IRA, I'm going to get physical gold, correct? Is that right, Brad? Is that what I'm hearing?
That's exactly right.
Okay. And Coy, I'll leave this up to either one of you to answer this question for me. But if I put money into a gold IRA, do I have to keep it in there for a certain time frame? Do I have access to my money right away? How quickly can I get it out if there's an emergency that comes up? What happens if I have to start taking RMDs?
Generally speaking, it's when you turn 59 and a half that you have access to the money. You can take it out earlier than that. However, 59 and a half is when an early withdrawal penalty of 10% goes away.
Got it.
I had a customer today that I was on the phone with, and that was actually one of the questions he asked, right? He says, well, what if I needed access to my money? How liquid is that account? And what I remind consumers is that an IRA is an IRA is an IRA, right? That account is no different than the account that you currently are holding, except for the product that is actually in that account. So really the biggest difference is that you're putting your money into a hard, physical, tangible asset that you have access to.
Well, folks, I want to thank you guys for joining us today. And Coy, thank you for joining us. And Brad, thank you for providing some wonderful insight today. If you're concerned about your money, if you're worried about where your money's at, if you're worried about how liquid are you and do you have access to your funds, I think we had some really good insight today. And I just would encourage you to call the people at U.S. Money Reserve. Talk to one of the experts, knowledgeable individuals like Coy and Brad standing by to answer your questions and help you. And we appreciate you joining us today from the U.S. Money Reserve Studios. I'm Remy Castillo. Thank you for joining us today.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.